when you want to exit your own position, but it was a very smart move to kind of understand the mechanism behind it and to abuse it and speculate against the big guys. And in consequence, some of the hedge funds actually went bankrupt, right? Because they suddenly had to pay a very high price in the future to buy back these short positions. Right? So it's a very risky thing because of this cash outflow which is sitting somewhere in the future. Now, to be fair, there are some useful applications of these short sales. So when we're later talking about derivatives, we actually need to have the opportunity to do short selling to be able to do the pricing of these products and to replicate them. Replicate basically means that you reconstruct them from other financial products. Otherwise, these products wouldn't exist. So put options are, for example, one example for this. This is a type of derivative that we're going to study in this class. And if you are an investment bank and you're selling these products, if you want to manage your risks from selling these products, you need to be able to do short selling. Right? So there are useful applications. And if you ban short selling completely, then these products like put options would basically be impossible to offer. Right? On the other hand, this is also used by speculators. And this is something that you find very often in financial markets, that the same products can be used for useful applications like risk management. And on the flip side, you can use it for speculation. Right? For me, it's the flip side of the same coin in that sense. And that's why there's so much regulation in the financial market to basically limit what the speculators are going to do and to still be able to do it kind of prudently. Okay. And then finally, you can of course do the short selling not only with stocks, but basically with any kind of asset that's traded in the financial markets. So suppose this was not a stock, but this was maybe a bond. How would that then work? The cash flows would still look like this here. If you sell the bond, you would receive money today, and then you pay this back in the future. And if you use a government bond for this, then you know exactly how much you're going to pay back in the future because the government bond is almost risk-free. And if you then just look at the stream of cash flows, that's basically the same as taking a loan from a bank. Right? If you borrow money from the bank, what's the cash flow? Well, you get money today, and you have to pay it back in the future. Right? So short selling a bond is really just the same thing as borrowing money from a bank. Right? And the reason for this is that the final payment that you have to make is 100% certain, which for shares it isn't. So I have this as a note here at the bottom. Right? So short selling bond is giving you the equivalent cash flows of taking a loan from a bank. That's in terms of cash flows identical. Any questions regarding short selling and the notation so far? Right, so please slow me down whenever I'm going too fast. These are things that I hope most of you have seen in your bachelor studies, but I know that some students here did not kind of study finance as their major, so I don't want to go too quick. Okay, so let's do some small computations and introduce returns. So returns are really just percentage changes of prices. So maybe let's start off with the kind of reasoning behind it. Why do we look at returns instead of prices? There's a question.
Yes, just to your previous sentence that you said, so that short selling a bond is equivalent to borrowing money. Is that a general rule when it comes to shorts, or is it just specifically for bonds?
It's just specific for bonds because, for example, if you do it with stocks, like in this example, you don't know what the future share price is going to be. Mm-hmm. And when you borrow money, you know exactly how much you have to pay back to the bank. So if the final payment, when you basically have to end the short sale, if that the payment is known to you already today, mm-hmm. then it's the same as borrowing money. Okay. Right? The risk part is really important here. Mm-hmm. Good question. Okay, so why do we look at returns instead of the prices themselves, right? We could just work with the prices. And the problem that we have, and this is a point that's basically coming from the area of statistics or econometrics, is that if you're looking at prices, they usually have a trend in them. They're not stable, right? So prices tend to go up over time. So, and if you look at the statistical properties of returns, they are actually much more stable, right? While prices tend to move up, the distribution of returns is remarkably stable. The second thing is, if you want to work with models in theory, you usually do assumptions on distributions, like what are the probability distributions. Again, if you do that for prices, you might have some weird effects. For example, you might have a positive probability of the price of something becoming negative, which for share prices doesn't make sense. However, returns can become negative, right? So it's very easy and convenient if you define your probability distribution based on the returns. Right? So these are the two reasons. You have trends in prices, and the returns are much more stable. And if you want to work in theory with distributions, it's much better to actually do this on the basis of returns because you don't have to worry about negative values. Returns can be negative. So that's why most of the time in finance theory, the distributions are defined based on returns. Right. And there is a third point, which probably has something, is more true only, or is probably only true for the second type of return computation here. You see, we go through this in more detail, but you see that there's the natural logarithm in here and is the formula. And this works remarkably well with normal distributions. So researchers are lazy people, so they choose definitions and formulas such that they can solve the problem easily, right? So if you work with these returns, you can actually solve formulas more easily than if you did this with prices. So we're going to discuss the model of Black-Scholes and Merton in this class, and they weren't inventive in the sense that they developed the formula themselves. That was not their achievement. They actually took a formula that was well known. It was the heat equation from physics. So they had some smart physics researchers solve the problem for them, and then they were basically twisting around the problem until they could use the formula. Right? So they reverse engineered the whole thing. Right? And they got a Nobel Prize for it. So that's the fun thing, right? So they were actually really, really lazy. They said, oh, there's this nice formula, I want to use that. So let's modify my problem until I can use it. Right? It's a very lazy approach. So that's very often the case in modeling and financial theory, is that people kind of tend to write down the problem in a way that they can actually solve it. Right? Another really easy example that you can all understand is that there are a lot of quadratic functions in kind of financial modeling and economics as well. Why quadratic? Well, if you compute the first derivative of it, it becomes linear, right? And the linear function is very easy to solve, right? So don't choose cubic functions because the first derivative is not easy to work with, right? Just choose quadratic functions. That's always an easy thing. Right? Again, people are lazy. Right? So quadratic utility in economics only exists because the first derivative is linear, right? Not because it's realistic. It isn't. Right? It is not the realistic form of utility. Okay, so that is a short motivation why we are looking at percentage changes rather than the prices themselves. Good. So let's look at the standard return. The standard return can be defined basically over any frequency or any time interval. Right? As a reminder, maybe let's do a short example here with two numbers. We have a time little t and a time capital T. And the share price as little t, maybe start with 100, just to make it easy. And after t years, our share price is 120. So it's very obvious. The discrete